The OCS for May 2020 and August 2020 is based on the fictional business of ChargeIT. Okay, so what we're going to do over the course of these lessons is walk you through each of these sections: your job and role, the company information, company operations, industry, the financial statements, the budget information, the tax regime in Eastland, and 2 articles at the end of the pre-scene. So what I'll do is talk you through the most relevant objective test theories from E1, F1 and P1 as they relate to this document, talk you through likely exam scenarios and different points of interest as we walk through each page of the document. So let's get started. Your job and role. You're told that you are a finance officer for ChargeIT. Your main role is to support a lady named Sophie Jacobs, the finance manager at ChargeIT. Your tasks include preparation of annual budgets, producing monthly management accounts, providing information to management as required, and assisting with the preparation of the financial statements and dealing with any queries regarding financial reporting. So that's our introductory section. So what I want to focus on is, first of all, the fact that you are not the person who is, taking the high-level decisions that affect the strategy of the business. No. What you're doing instead is you are assisting the decision makers in this business. You are a relatively lowly finance officer. As you work through the levels at CIMA, you go to the management level, the strategic level, you will work up through your organization. By the time you get to the strategic level, you will be consulting with the top people at the business, the CEO, the board of directors, etc., on strategic issues that affect the company over a 3 to 5 year time horizon. But the operational case study sees you assisting managers so that they can make decisions and monitor the implementation of the strategic factors decided at the top level of the business. So you're dealing really with day-to-day issues, operations. You're dealing with issues that play out over a 3 to 6 month time horizon, for example. So you're going to be dealing with this person, I think, a lot on the day of the exam, Sophie Jacobs, the finance manager. But there's also the potential that you would be dealing with people who are non-finance people. So you could be dealing with someone from HR, you could be dealing with someone from marketing, and you need to keep that in mind. If someone comes to you from marketing, for example, with a table of figures, budget figures versus actuals, and they're asking you to comment on variances, you need to keep in mind that they are a non-finance person. So any technical terms you would use in the exam, you need to unpack a little bit, okay? So that's the first thing. You're assisting the key decision makers. You're meant to give them information and clarify anything they bring to you so that they can go away and take sensible decisions. This is an exam that can throw anything at you, really. It's pretty broad in what it can ask you. They're talking about your main responsibilities being management, accounting, and financial reporting. So a lot of the issues you deal with will be quite technical, related to P1 and F1. Now, a lot of students worry about whether they will have to do calculations on the day of the exam, and that will not be the case. So instead of having to do detailed calculations as you would in the objective test subjects, instead what will happen is you'll be presented with technical information. So you might get an extract from some financial statements for you and a rival company, for example, and you'll be asked to compare and contrast sensibly, but the information will be given to you. You might be given a table, as I said before, of budget figures versus actuals and asked to comment on variances. You won't need to calculate the variances, they would be given to you, but you do need to comment sensibly on them. So that's where your technical expertise comes to bear, okay? And E1 also plays a role. And E1 is the subject that has changed most with the move to the new syllabus. Okay? So what we're seeing CIMA do with the new syllabus, the 2019 syllabus, is introduce topics related to the digital world. Okay? So that is really what CIMA is pushing. They're expecting finance officers to demonstrate technological savvy. You're no longer just a number cruncher. You need to go beyond that. You're a business partner, and you need to be comfortable with technologies. And I think in this particular pre-scene, the role and activities of the finance function and the finance function becoming a more modernized finance function is going to be a big issue, because we'll see in a few pages' time that it's mentioned that the finance team has been doing the same old thing for many years now. It's a small team, and they're just doing, processing transactions on a daily basis. They don't go much beyond that. That is a big red flag, I think, because it clearly points to this being an old-fashioned finance team, and I would not be surprised to see CIMA ask on the day of the exam how the finance team can modernize, how they can use different technologies to modernize as well. So digital technologies are going to be a big part of this particular exam scenario, I think. And using data in a more value-adding way. So not just preserving value, but with the processing of transactions and ensuring they're accurate, as the finance team does currently, but creating value, okay? Interpreting the data, making sense of the data for the decision makers at the business so that you assist them, in a value-added way. So we'll be talking about those things as they relate to E1 as we work through this pre-scene analysis. A word in your role then as a finance officer, which I've hinted at. So you're assisting decision makers. You're involved obviously with management accounts, with financial reporting, but you could also get something from E1 thrown at you, and you will get a lot thrown at you from relating to E1. So you've got a short-term focus. As I said before, as you move up through the levels with CIMA, your focus shifts to the medium term, i.e. 1 year and beyond for the management level, and to the long term at the strategic level. So that's 3 to 5 years. At the strategic level, you're dealing with issues like deciding on, the best product categories to enter, new markets that you'll be entering into, securing long-term financing. But as a finance officer, you're going to be advising more on operational day-to-day issues, getting short-term financing in place. And here are some of the big topics that come up again and again. Costing, so activity-based costing in contrast to standard absorption costing, which is what this business ChargeIT has in place. Budgets and variance analysis, so comparing budgeted figures to actuals. In the pre-scene, you're given budget figures for 2020. Think about how the coronavirus is likely to have disrupted businesses utterly. Businesses that have established budgets are going to see their actuals fall to zero. And they've got this massive gap then when they're doing their variance analysis in the next few months. Working capital management and cash management over the short term are going to be key considerations as well. And managing risk sensibly in the short term is important too. So that explains, some of the main topics impacting on your role as a finance officer. The other thing I want to say at this point is you need to give ethical advice. CIMA expects its students and future finance professionals, future qualified finance professionals to be ethical. So it's not just about giving advice that makes sense, in terms of, the bottom line impact for your business. You need to ensure that what your business is doing is also ethical, and what the advice that you give is ethically sound. So watch out for potential abuses of the CIMA Code of Ethics. So definitely refer to the CIMA Code of Ethics if you're faced with any kind of ethically questionable behavior. on the day of the exam. CIMA loves to see this model being referred to. So refer to the 5 principles from the CIMA Code of Ethics: objectivity, professional competence, confidentiality, professional behaviour, and integrity. And make sure that none of those 5 is being violated with anything that you recommend or anything one of your managers is recommending. Now, there's something that I can think of, a potential abuse that could pop up, and we've seen it come up in past exams. This business is owned and run by 2 people. So they've got a lot of influence. They own all the shares and they run the business on a day-to-day basis. So they've got a lot of influence at the business. It's a relatively small company. It's kind of small, medium-sized, and you may well have a scenario where, you know, the owner of the business comes to you, maybe wants to press you to present revenue figures in an overly optimistic light, and asks you to book, lots of revenues up front that are related to services that would actually be rendered next year, for example, and you've got to push back against that. Okay, so give ethical advice. Next, we have the company information, which is being revealed over the next few pages. So the company background, first of all, tells us that ChargeIT, what it actually does is it develops, designs and manufactures cordless domestic electric products. And it's operating from Eastland, a fictional country in the non-fictional region of Northern Europe. And it's got a fictional currency of the e-dollar. Okay, so unpacking that a little bit. First of all, the fact that Eastland is based in Northern Europe indicates that we're likely dealing with a developed economy. And there are pros and cons that come with that in relation to ChargeIT. So first of all, the pros, the pluses of being based there relate to a likelihood that they have access to better infrastructure. So roads and things like that are likely to be much better, which is important for this business because, you know, they're transporting their goods around their home market constantly. And the workforce is likely to be well educated and pretty well skilled. So again, that's important. And we'll see, you know, that this company relies on highly skilled workers, especially in the area of research and development. You know, so it's important that they've access to well-qualified, well-educated candidates. And also, customers in this country are likely to have a good degree of purchasing power to purchase the goods that they're producing. So they're all pluses, obviously, of being based in a wealthy country. Now, the negatives of being based in a country like Eastland are that there are likely to be higher costs associated with the activities that the company carries out. And we'll see in a minute that they have moved the manufacturing operation from Southeast Asia back into Eastland in recent years. It says it down here. So definitely higher cost to operate in a country like Eastland. And also you're going to have more of a regulatory burden. So it's likely that the government plays more of a role in this particular country than it would in a developing nation. And obviously that represents also a cost to doing business. So then we're told that the owners of the business are also managing the business. So Gavin Mansell and his wife Anthea, they own 50% each of the business. So they're the main shareholders and they're also running the business. So it's endured for the last 19 years. So they've got some staying power there. And they're very fixated on product design. So it's a product-centric business. Now, just an early sort of point to consider here is with the company being so product-centric, and that's kind of hinted at again and again throughout the pre-scene, it sometimes happens that a company that's very, very fixated on the excellence of its product, which is obviously a great thing, it can be so focused on producing the very best product that it kind of ignores everything else. So it kind of loses focus of, you know, the customer needs and, you know, having more of a market orientation. So that's just something to watch out for. And as I said before, manufacturing was actually originally outsourced to Southeast Asia before, but in 2016, so only a couple of years ago, they actually took manufacturing back to Eastland. So again, they'd have more control over the product if they're manufacturing in their own facility in Eastland, coming back to that, product focus. So this is a company that's making high quality products, but they're bearing a lot of cost to obtain that excellence, and that will be hinted at throughout the pre-scene. So often, you're talking about a trade-off, but really between quality and cost. If you go for something that's very, very high quality, it's likely that it's going to cost you a lot in terms of quality checks, in terms of raw material inputs, etc. But certainly it seems this company is very fixated on high quality. So let's talk a little bit then about the fact that this is it's a family-owned business, okay? And it's privately owned as well. So this is a company that is not listed on the stock exchange, and there are pros and cons that come with that. So first of all, there's going to be less public pressure for a privately owned business. You're not subject to the same rigors of the stock market. You don't have the same onerous regulations in terms of, having audited financial statements every 3 months, and being, having to field, calls from investors and analysts at banks, etc. So that's obviously, less fuss. But the big negative with being a privately owned business is that the company is likely to have fewer financing options. So they're dealing really with if they want to make a big investment, they're dealing with 2 options really. 1, using the cash generated from their own operations, or 2, going to the bank and getting a long-term loan. But they cannot tap, the third big source of financing, which is equity, i.e. selling their shares on the stock market. So family company, there are pros and cons with that. The pros would be that family-run businesses tend to take a longer-term view. There's a kind of a sense of solidarity. We're all in this together. We can trust one another. They're my family members. And, there's no agency problem. You would have come across that term, I'm quite sure, already in your studies. The agency problem is what occurs when the interests of the owners of a business and the people running the business are not aligned. Okay, so in a typical scenario, you've got the shareholders of the big business, they've bought the stock, and the board is meant to represent their interests as the owners of the business. And the board is overseeing the activities of the executive team who carry out the day-to-day activities of the business. So that's the CEO, the CFO, etc. And what you sometimes find is that the interests are not aligned. So you have the CEO and CFO acting in the short-term interests, their own interests, to the at the expense of the long-term interests of shareholders. But that's not going to happen in this case, because the owners and the people running the business are one and the same. So there's no problem there. Their interests are obviously perfectly aligned. So let's move down through the rest of this page. The company has grown rapidly, we're told, in spite of the fact that the market for vacuum cleaners has been contracting in recent years. So as a result of investment in research and development, it's built up a lead in battery technology, and that's allowed them to be very innovative. And we can see that the result of all of this innovation and high quality is that the financial figures are really quite robust. So sales revenues increased 32.4% in the previous year, 2019 versus 2018. We'll talk about that in more detail when we review the financial statements of the business. And the profit before tax is up 59.4%. So that indicates to me that they've got a good handle on their costs. Remember what I said before, it tends to be a trade-off between high quality and cost. So if you opt for high quality, it's likely that you're also cooking in a lot of cost into your business because you've got all these quality checks, you've got high quality raw material inputs. You've got, highly qualified people you're paying high wages to. But the fact that this business sees its profit grow faster than its revenues means they've got a good handle, most likely, on their costs. So we're definitely seeing a business that has what Michael Porter would refer to in his generic strategies as being differentiated. They're not a cost leader, okay? They're not trying to keep the costs down and to charge a low price. What they're doing is they're comfortable incurring some higher costs to ensure a high quality product. And they're likely offering their products at a high price point to people who are willing to pay for something that is higher end. Okay, but there are challenges that have come with this growth, we're told, because of this rapid growth. They've presumably had to hire lots and lots of people very quickly, and there have been challenges in terms of managing the business, managing the staff, and getting the right infrastructure in place. So what we're seeing here is some likely exam issues being flagged up. I think it's likely on the day of the exam that you're going to be asked to propose some solutions to these potential challenges, okay? The challenges of rapid growth. Ensuring that you have good change management policies in place, using digital technologies to facilitate this fast change, having the right performance measures and KPIs in place so that you're tracking the right things and you know how to improve on the different parts of your business because you're actually putting numbers on the different parts of the business with the right key performance indicators. E1, thinking of E1, business process reengineering. It's clear that this company has been, rapidly growing, and maybe it seems to me that, things have gotten away from them as they've added more people, and they're kind of just throwing more manpower at the thing rather than taking the time to ensure that each of their processes is as efficient as it can be. So a good way maybe to examine the processes of the business is through business process re-engineering, kind of starting from the ground up and building the processes again and seeing if they can gain some efficiencies there. Moving on then, the products, we're told, that they offer floor care products and garden products, okay? And they're selling both through their own website and directly to major retailers. They've got sales in the USA, in Europe, but they're still very reliant on their home market of Eastland. So 75% of their sales are coming from their home market of Eastland, which I think means they're a little bit too reliant on one market, and 25% then go to the USA and Europe. But that still opens up, the possibility for expansion into Asia, the Middle East, Africa, etc., and also to expand more aggressively perhaps into the USA and Europe. So they're exporting. We don't know if they're importing, materials, but I think it's likely that they are. So they're, dealing with a lot of different suppliers, we're told later on, to purchase the individual components that go into their hoovers, etc. So it's likely they're going to be exposed to some currency risk, exchange rate risk. So that's one of the risks they need to manage a little bit over the short term. Quality products then are being produced, as I said before, and they are a reliable supplier. So this is a company, I think, with strong brand power by the looks of it. And that is a good way to stand out. It's a good way to differentiate your offer in a crowded space. And this is a contracting market, remember. This industry is in decline, but this company is growing and growing aggressively. So it's not just that their products are high quality. That's not enough on its own. You need to make sure people know that. So that relates to marketing, okay, and brand. But that again is costly, okay, because you need to spend money on advertising. You need to spend money on different brand initiatives. So let's take a look at the products. First of all, we have floor care products, vacuum cleaners. You've got your traditional upright and stick vacuum cleaners, and then you've got more mobile handheld vacuum cleaners and the more modern robotic vacuum cleaners. So we've all seen, I think, these. I want one myself. These little robot cleaners that you leave at home as you go out, whenever we're allowed to go out again. But you can control them with an application on your mobile phone, and they do the cleaning while you're out of the house. So this is certainly a growth area, as we'll see in a couple of pages' time. They also have garden products, so lawnmowers, grass trimmers, hedge trimmers, and again, automated robotic lawnmowers. So this relates to the technological topics that come up in E1. Artificial intelligence, the Internet of Things. These are controlled remotely. You get readings on these machines on your mobile phone that's connected, through Wi-Fi to these devices. So it seems the company is, quite cutting edge. So let's move on. The company's strategy is next. And the aim of the business is to develop its product range, so there's that product focus again, whilst meeting environmental standards and providing the best quality products, the best quality service. And also, and we're seeing this for the first time, and I mentioned it earlier on, developing new markets for its products. So quite reliant on their Eastland home market, and I think it's good that they're targeting new markets. So this is a company in accordance with Ansoff's matrix from E1, that is focused first of all on new products in its existing market. So that is product development. And also they're focused on new markets with their existing products and new markets with these new products, presumably, that they want to develop. So, they're covering 3 of the 4 quadrants there in, Ansoff's matrix. They've got product development, they've got market development, and they've got diversification. So diversification is the riskiest of these approaches because it means they're developing new products and going into new markets. So they're assuming higher risk with that. The safest option would be to stay in your own little existing market and offer the same products as always, but then you run the risk of standing still and being overtaken by rivals. So mention of environmental standards, and of course that's becoming more and more important for governments, for consumers, and indeed for businesses themselves. They want to reflect the concern that people have with the environment. So this is a company, it seems, that is at least talking of being environmentally conscious, which relates to CSR from your, so that it relates to CSR from your E1 studies, so corporate social responsibility. So what I would ask you to do is to watch out potentially for any actions or anything that occurs that runs contrary to that promise. They're telling us we want to be environmentally responsible. It could be on the day of the exam, that it comes to light that they're dealing with a supplier that is, polluting left, right, and centre, and the company has a decision to make as to whether it cuts ties with the supplier. Okay, let's move on. So to achieve the aims of launching these new products and going into new markets, they're constantly investing in research and development. Now, it's important to mention that the research and development area is where a lot of cost actually gets cooked in. I forget the study I came across not so long ago that said on average 80% of cost is cooked in the research and development stage, because decisions are being made at this point about the materials that would go into a product, how the manufacturing process, etc. So this is where the costs are sort of decided on. So if you want to cut costs, this is a key area to look at. So they're investing heavily in research and development, and they want to promote their battery technology, which they're a market leader in, to a wider group of consumers. So, that would relate to, the robotic vacuum cleaners and lawnmowers, etc., that are being used, which tend to be cordless very often. And a big key long-term aim of the company is to promote the benefits indeed of cordless appliances. So they're seeing there that customer preferences are changing now. Customers want cordless devices. So this indicates, I think, that the company is responsive to market trends. So with all of this in mind then, the company is investing heavily in new manufacturing equipment. It has identified a need, however, for future investment in its central systems and processes to support their ongoing product development. So, again, I think this is flagging up a very likely exam issue. Investment is needed. New manufacturing equipment and processes, new central systems to manage everything, basically. So it could be, that we're dealing with, an enterprise resource planning system that needs to be upgraded or installed. So, that they're tracking, the receipt of goods from the moment they arrive at their factory, through the manufacturing process, through delivery to the end consumer, and they need to modernize that system. So that could be one such system they're talking about, enterprise resource planning. Now, because they're talking about investment, we need to start asking questions about where is the money going to come from. So we're talking about probably significant investments, which means property, plant and equipment. So it's likely if they make a big investment that it's going to impact, their non-current assets, the property, plant and equipment, and there may be associated high depreciation or amortization costs as well that would impact on the profitability of the business. So thinking about your F1 studies there. And where was the money going to come from? How are they going to finance these investments? Is it, have they got enough in cash on standby? Or do they want to go for, a loan from the bank? So we'll talk about that more in detail when we look at the financial statements. So the people at the company, we have 250 employees. 120 of those employees work in the production and research and development area. So we've got 48% of the business there. We've got 75 in logistics, so 30% there. And the remainder, i.e. 22%, are covering the different support activities here. So that is administrative staff in marketing and sales, finance, IT, HR, etc. The staff numbers have grown rapidly, which is representing a challenge to HR. So think of the HR area. At the moment, what we'll see very shortly is that the finance director is actually heading up HR. So the finance director is responsibility for not just finance, but IT and HR as well. And I think the company could usefully look at employing a separate IT director and a separate HR director. And I'm not surprised they're having issues with, human resources because they don't have a dedicated person to this area. So I think it's definitely worth looking at that. And there are other issues then related to HR management that you would have come across in E1, relating to motivation, how to motivate your workers, how to compensate them and incentivize the right behaviors, and to overcome resistance to change. This seems to be a fast-growing company and it's changing very rapidly. If you don't manage those changes well, you're going to end up with unsatisfied workers. The directors then at the company are the two people we talked about before, the husband and wife team who own the business, Gavin and Anthea, and the three other executive directors that we see here for R&D, the finance director and production. It's a young and highly enthusiastic directors team, so I think they're more likely to be quite risk-seeking in nature, which might explain why they've grown so rapidly. So it would, stand them in good stead. It has done in the last few years. However, as the company becomes more mature, it could be that they need steadier, more experienced people in charge, particularly to manage the company through times of crisis, which, you know, would be very relevant, I think, to what's happening right now with the coronavirus. You know, that represents a different kind of challenge to this particular business, because it's been all about growing. And at the moment, for a lot of businesses, it's just about staying alive. It's about, you know, cutting expenses and positioning the company for a return to form when all of this passes. So Gavin and Anthea, what they want is profitable business development. That's the aim of the business. So it's going to be important that they keep those costs down while they go on expanding into new markets, while they go on developing new products. So that's the big challenge that the company has. And as I said before, as a family-run business, as the key decision makers, Gavin and Anthea, you know, there are pros and cons that come with being a family-run business that we referred to a little while ago.